Hey everybody, welcome to the morning market briefing. Tuesday, 6/9/2026. Hope you're doing well out there. Hope you're having a nice day. Tom, Ben, how we doing?
I'm feeling great.
Woo!
It's going to be a big day. We got a lot to talk about.
Lots to talk about. I want to start off with the AI story. I think that remains top of mind. Specifically, Ben, there was a great tweet yesterday summarizing one of these specific AI deals that we'll get to maybe last in this segment, but just a continued ramp up, massive amounts of capital flowing.
Yeah, China is preparing a almost $300 billion fund to fund a nationwide AI build out. This is a massive deal. I mean, if you just think about what TARP was and then what this China AI build out is going to be, that's massive, $300 billion. It's also about what the CapEx is going to be for Google next year. Actually, probably a bit less. So, and that doesn't mention all these other companies. So what's interesting here is that Huawei is going to be providing at least 80% of the technology, so effectively squeezing out NVIDIA and AMD. So it bears a couple questions. One is China reaching the limits on how much they can put into this? And then secondly, even if they do put all this money in, are they going to get the bang for the buck because they're not using the top chips? So that's a question there. The Korean stocks are coming back. This is something I was thinking about just watching the Korean markets. You see so many of these economies. These are real countries with real people and real economies and real savings and real retirements. And they're either not diversified or they're diversified in bad companies, like in Germany, for instance. Yeah. Or they're solely dependent on one sector, like in Korea. I mean, Korea has a lot of other companies. I mean, they have a lot of car manufacturing going on, but every day it seems like the stock market is limit up or limit down. It hits circuit breakers every day simply because of their memory chip companies. And I just imagine if in the U.S. we were up to 8% or down 8% in your portfolio every single day because it was all Samsung and SK Hynix.
I mean, I'd like today,
yeah.
I mean, it's an interesting thing because we've talked a lot about big breadth on this podcast and how much we like that. But really over the last month, we've seen that move away. We've kind of gotten into this cycle in a certain degree. I mean, we're boom or bust on performance the last week or so because it really is dependent on what is AMD and Intel doing, Micron, what are they doing versus what is the market at large doing.
And that's relative performance. So the market will swing one way or the other, and then we'll probably just be in the middle. Like we went down less on the down days and we went up less on a day like yesterday.
Yeah, so you're seeing, I mean, huge numbers, up 50, 60, 70% in some cases since the beginning of May on some of these stocks. And, you know, a lot of that is just it's the same type of stocks that are swinging wildly in Korea. They're just a smaller portion of our stock market for now. And that's really driving performance. And we moved away from the first part of the year. It was like Johnson & Johnson couldn't be stopped and was outperforming NVIDIA and Microsoft, and Starbucks was doing really well, and all these different companies that had kind of gotten no shine for a while, ExxonMobil, were suddenly outperforming the market at large, and we're seeing a wide breadth in the market. And now we're not really seeing that. We're basically seeing the stock market being driven by a handful of stocks that have grown quite a bit in a very short period of time. And that's really, I think it's muddying the waters as to what's actually happening, because it's like, man, the stock market's really hot. But if you don't own those stocks in certain quantities, like, you're not really seeing that. And I think, we've talked a lot about the Bitcoin money's been flowing into that. They've sort of hit meme range where everybody's having this FOMO on these chip stocks, and that's driving the markets on a day-to-day basis, whereas the average stock really is not.
Yeah, it's interesting to think about that whipsaw effect. I mean, you think about even just and this is not a criticism of clients by any stretch, but you think of even the uneasiness that, we had a number of clients that retired in 2022, for instance. And 2022 was a tough year, regardless of how you were positioned in U.S. investments, but 8% moves on the daily. I don't know how you ever sleep. It's amazing to think about. OpenAI, filing their S1. They say it may take a little while because there's some stuff they want to get out of the way before they go public, which is kind of, I found that a little bit of the saying the quiet part out loud where it's like, hey, look, we kind of want to maybe maneuver some things first.
Definitely. I think their hand was a little bit forced by Anthropic filing to go public last week, and so OpenAI doesn't want to go public necessarily after Anthropic. Anthropic, by the way, expected to make an adjusted operating profit, which is basically operating profit before stock-based comp, in Q2, in the June quarter. They still might lose money for the year, but I think that's the first signal that we have of an AI company actually making money. SpaceX obviously losing gobs and gobs of money. OpenAI expects to lose money as far as the eye can see, and Anthropic actually making a profit makes it so that OpenAI seems a little bit less valuable by contrast, and I think that that's going to be a story to watch. But a lot of companies, and this is not a surprise that OpenAI wants to come public, but and it was going to happen, and now it's happening.
We've been hearing about this big Apollo, Blackstone, Google, Anthropic, Broadcom deal for several months now. Now getting some clarity on how this is going to look. Shout out to Zero Hedge on Twitter, who I think had the best summary. Broadcom is backstopping a massive $36 billion private credit SPV with Apollo and Blackstone, which will help Anthropic buy Google chips made by Broadcom, even as Google is renting compute from SpaceX, while Morgan Stanley, which is arranging the deal, lends money to investors. So, Ben, if you're following the money, where does the money start and where does it stop?
The money ultimately starts from private credit funds and investors in private credit funds, and it flows to the chip companies, with the AI companies siphoning off a bit along the way. And to give you an idea on some of these private credit payouts, the super senior A1 notes are floating at T plus 100, Treasury rate plus 100. The $25 billion in first lien senior A2 notes will give you a 550 to a 575 all-in yield, and the $4.5 billion in second lien B notes will give you 8.5%. But I think what's interesting to note here is that we've essentially swapped. Everyone talks about when you go into bankruptcy, if you own the debt, you'll go into a bankruptcy restructuring and you'll own equity. You'll get wiped out of the debt, but you'll own equity in the surviving entity. This is like the opposite of bankruptcy. So essentially what they're doing is they're taking equity-related cash flows and they're converting that into a debt instrument. So you're taking this stream of cash and you're saying, no, that's not equity. We can convert that. And that's what they're doing. It would be like buying a basket of stocks, call it like 10 or 15 stocks. S&P 500's been up, 15% a year. And what they're going to do is every year they sell some of those stocks and give you a 7% coupon. And they're saying
it's not unlike an annuity.
Yeah.
It's not unlike a index tracking annuity. Not all of them, but some of them, in which they're saying, hey, I'm going to lock you in at a 7% return. Doesn't that sound nice? I'm going to go buy a bunch of stocks. And when the market's up 15, I'm going to give you 7%. And when the market's down a little bit, well, I retained 8%. I'm going to give you 7%.
Well, it's like what it's really like is that Fernando Tatis deal. I don't know if people are familiar with this, but Fernando Tatis Jr., known baseball superstar.
Sold what, 10%?
He sold 10% of his future earnings to get a $2.5 million payout when he was a rookie. So the idea is like, you give me $2.5 million now, you can have 10% of my future earnings. But then he signed a mega contract, and then he tried to sue to get out of it. But I guess it was a law firm or an agency.
Yeah, he tried to sue saying that it was like predatory lending, but it was not actually a lending. He sold the right to future baseball-related earnings.
Yeah, and he didn't have to pay back the $2.5 million. I assure you that has been spent.
Yeah.
But it's like, but now he's on the hook for tens of millions of dollars, and if he continues to be an excellent baseball player, then he will continue to owe them 10% above and beyond his agent. I mean, it was an unbelievable deal on their part.
Yeah.
But the risk, they very much took a risk on the front end because, he blows an ACL or tears an Achilles and his career is over and they're out $2.5 million. I
don't know if Fernando Tatis III is coming up the ranks yet. Probably not, but if he is and he wants to talk, we could put together a deal like that.
Though there was a very fun early Twitter period where Fernando Tatis Sr. was taking requests of him drawing stuff on Microsoft Paint and then tweeting out the pictures. And it was one of the weirdest things that ever happened on Twitter. This was probably a decade ago.
Yeah.
But, it's good to have the Tatis boys out there creating content. Just makes it easy for us.
They keep the wheels turning on the economy.
I think the takeaway for me on the Apollo, Blackstone, Google, Morgan Stanley, Anthropic deal
we got to get a name for it.
Yeah, we need an acronym.
Is that
I think it's I think I'm going to call it the ABGAB.
Yeah.
If
Apollo, Blackstone, Google, Anthropic, Broadcom.
If you are Google and you can either go through this rigmarole over the last 2 months and deal with Apollo and Blackstone and all these chefs in the kitchen, or you can just issue equity. And I think that
now
I think that we're starting to see, like, if this is what the extent that we're trying to get get the private credit, and yes, this does optimize your cost of capital. They're paying probably an average of 6% maybe on this, which is a very attractive deal. Just issue the equity, get the money, and start.
It's pretty easy.
Start hammering it out.
The thing is, I don't really even think it's that attractive. I mean, you can buy mortgages over 5 and have.
Yeah, you don't find it that attractive to the investor.
Correct.
Yeah. I don't know why. Well, I guess if you leverage it.
Yeah, then that's I mean, this is what happened in 2007
Yeah.
is where you start leverage on leverage on leverage and derivatives based on all these different things, and then one, linchpin breaks, suddenly the whole system collapses. And I mean, this is why I worry about the lack of breadth in the market right now, because it's like if you aren't chasing these things, you aren't making as much money as everybody else. However, when it ultimately goes, everyone's going to be in the same trades. And so, while it may not be overtly sexy to own Johnson & Johnson stock, which is doing fine for the year, if not better than the market, I know on a day when Micron's up 7% and Johnson & Johnson's up 50 basis point, it feels like you're missing out, but you really aren't. What you're doing is you're protecting yourself in the long term. I mean, look at Bitcoin. This is the thing, is that no one is coming back. Your Uber driver is not telling you how much he made on Bitcoin anymore, because if he continued to own his Bitcoin, he's made no money. And that's where these things start to get into, like, oh, I made a ton of money on AMD. It's like, well, not for the previous 5 years. And so this is why you need to be actively trimming these things, because if you don't sell when they get toppy or even extremely extended, which I'd argue some of these stocks are, and buy things like bonds right now when they're cheaper than they probably should be, then you're opening yourself up to being the guy who made a ton of money on Bitcoin and now is down on Bitcoin.
It's very interesting when you think about the role of, and I'm going to contrast this with finance and financing right now, but the whole role of the finance industry is to reduce the transaction costs. That's why they're involved in IPOs. That's why they're involved in banking. And the winners in financing are able to lower the cost of capital, just basically grease the wheels of the economy. That's all the finance industry is. It's just grease. And what your goal here is to lower the cost of capital and lower the transaction costs for everything. And if you're able to do that, you can generate more business, you can generate more operating profit, and overall the competitive landscape of finance, especially in the United States, has brought these transaction costs exceptionally low. But the problem is they always turn the dial one more time, because there's that profit incentive. And so that's what we saw with mortgages. They said, hey, here's this cash flow stream from a single mortgage. If we bundle them up and tranche them out and lever them up, we can have these CDO squareds, and it's going to generate great returns for the investors, and it's going to lower the transaction costs because more investors can get in, and it's just going to grease the wheels of the economy. The problem is, to your point though, Tom, that as soon as that gear hits a roadblock, the whole thing stops and the grease just piles up and it goes kablamo.
I mean, this is why Puerto Rico doesn't work as a municipal entity, because you've got moral hazard in what you're incentivizing people to do. Puerto Rico is a sparsely populated non-state, and their debt, if you buy it, is federally, state, and municipally tax-free. So if you live in California or you live in New York City, where there are New York City income taxes, you would love to buy Puerto Rico debt. And there are a lot more people in New York City than there are in Puerto Rico. And so Puerto Rico is incentivized to issue that debt. They can take out as much debt as they want because people will buy it and they love that. But then what happens is a hurricane hits and people are without power and they've issued all this debt and now they've got to rebuild the infrastructure. But you've already issued a ton of debt for that infrastructure and you can't issue anymore. And not only that, but nobody wants to pay it. And so then people start using cash. And now suddenly those Puerto Rico bonds are worth nothing because you've incentivized them to issue debt. You've not incentivized them to grow or do all these things. It's like you're just facilitating other people buying the debt. People want it, so you make it. But the problem is there's nothing backing it. And that's what you end up with is a moral hazard problem of like you've lent too much money and there's not enough cash flow.
There's no path out.
Yeah.
Apple yesterday, kind of a nothing burger, Ben.
It was very boring. I was excited about it, and
it was a snooze fest.
I mean, even the speakers sounded like AI. Maybe they were. I just heard it over the wall, but boring.
They were very dull. Siri AI will be the new Siri. It'll start in beta toward the end of the year and then probably be rolled out more in next year. And that was basically it. Image generation they'll have, but that's going to have daily usage limits, and Siri AI will not be available in the EU or in China because of regulatory. So I don't think this really matters. I think it removes a little bit of a catalyst, but Apple has accelerated iPhone sales over the last year despite not really having a better product or software anyway. So I think they're going to be okay, but it was dull.
Yeah. We did get small business optimism. Some interesting commentary. What do you think of the report at large?
Not good. I contrast this to what we're about to talk about. Bank of America saying there are too many red flags in the economy right now and in the markets. Too much high sentiment. And you read this report and it's like, where's the positive sentiment? Because a lot of people in the small business survey or in the consumer confidence survey are not seeing that. You are seeing. I did want to call out price plans. Do we have the chart on that, Hicks? The price plans have kind of broken out over the last couple of months. We bottomed out at 24 in March before the Iran war really extended, and now we're at 34, which is the highest it's been in Trump 2.
Explain the price plans.
So this is the percent of small businesses who expect to raise prices over the next 3 months. So a lot more, and then you kind of take the difference. So a lot more people expect to raise prices over the next 3 months than cut prices. They don't really expect to invest in CapEx. They're hoping that the uncertainty resolves related to Iran. Essentially, this is a little bit of a subdued report. I also thought was interesting the outlook for general business conditions 6 months ago. 6 months from now is the lowest it's been in the Trump term as well. So a lot of small business people, the consumer confidence people, they're not feeling it in the economy, and they're out on Trump too.
Tough times. Bank of America, as you alluded to, saying that things are too many red flags. We got to swim more cautiously.
Yeah, this was surprising. It would have been nice if they came out with this note prior to Friday when the market sold off a lot. I actually don't think sentiment is as stretched as they say. They also talk about price earnings ratios. One of the big things is that the S&P 500 long-term growth expectation is now higher than it's been normally. It's kind of above that one Z-score, one standard deviation above mean, which I actually think makes sense given where we are in the economy and the AI improvement. But they draw some comparisons with 1990, 2000, 07. But they also draw a comparison with last February. And to me, that's kind of irrelevant. I forgot that we actually had a market pullback last year. I mean, you could have said that this February.
Yep.
So I'm not really reading too much into this, but I'm sure it's going to grab headlines today. It already is.
Tom, we're seeing some separation between interest rates and oil. Oil below $90, but interest rates still kind of doing their own thing. How do you digest it?
I mean, I think sentiment is extremely bearish on bonds right now. We had a little bit of an internal chat this morning in the investment team's chat that was basically like, what is the bond market signaling? And I think what's interesting is that if you look at a normal expansion era spread between the federal funds rate and the 2-year Treasury, it's usually between 50 and 100 basis points. So that's kind of where we are. We're like right at 55-ish between the federal funds rate and the 2-year Treasury. And I think that the 2-year is doing what a market rate should do, which is that there's price discovery on the 2-year. There is not on the federal funds rate. It's just set. And so it's going to stick wherever it is. And we talked about this a lot when, we were stuck at 5% and the 2-year Treasury was inverted or below the federal funds rate, indicating that it should be lower. But in a hiking or cutting cycle, that's going to be the case. It's going to tell you where the market thinks it should be. And I think the market is saying we're worried about the fact that inflation is, at least in the short term, in the next 2 years, higher. It's worried about the fact that the jobs numbers continue to be elevated, which I think you can really take with a grain of salt. But that's what the market is telling us, is that we're in an expansionary situation. The market is actually good. We are seeing inflation tick up, and we are seeing the jobs market be strong based on the data we're seeing. I would say that the expansionary data is, solid B+. I'd say the inflationary data is a C at best. And I would say the jobs market is just, you could almost throw that out completely, because completely nonpartisan, we wipe off all of the jobs. Whether it be Biden or Trump, we've not added real jobs in a long time. And the anecdotal data, at least from all of the earnings reports, would suggest that the jobs market is worse than it actually is. And so when you put that all together, the market, there are 8 billion participants, they're saying this is where we think where we should be, which is about, if you say we should be 100 basis points above inflation, then we're at, call it a 415, and inflation is somewhere around 315. Even the Fed expectations of inflation ticked down when they were released this week. We're seeing that the idea that inflation is going to spiral out of control is waning, but the idea that it's going to be much lower is not. And I would still argue that they're not taking into consideration the housing market. But there's also, the impetus of this entire conversation is the market reacting to Kevin Warsh potentially hiking rates? And my argument would be no, because one, he's not doing anything yet. And two, the market is hiking rates on itself. So you don't need to hike rates if the market has already done that. And that's why markets are efficient and interesting. I would say we might be oversold, but the expectations are based on data, which is indicating expansion in jobs, and inflation going up. And that is a logical place for it to be.
And we're going to get CPI tomorrow, and everyone are freaked out about how high the CPI number, and then we might get a 4% plus print on the headline. But on a month-over-month basis on a core, we're probably going to be plus 0.2. And I think that this will be the last big headline before inflation starts going down on the headline again. So,
and oil's been down and sustained down for a while now.
Yeah,
and it's not 115.
And that's going to filter through more so in the June report, and it just gives me more and more confidence that this will be the high water mark, in which case then the market will start thinking, oh, we're in an inflation downward trajectory again. And it's just, it kind of goes.
And they're like, how many cuts are we going to get?
Yep.
And the answer is 1, maybe 2, I think.
Yeah. Yeah.
And I've been pretty steadfast on that, and I still feel that way. So,
yeah, it's interesting to see. I think the nuance that you alluded to, Tom, there in terms of the market setting the other rates, I think that's often lost. And I think the other side of it is something we talked about, I think maybe last week on the call when we talked about the risk-free, the equity risk premium. That's a factor as well, because when we talk about the earlier story on, the role of finance is to grease the wheels, there is the supply and demand component, who wants these bonds at these rates, but there is also, would I rather have those bonds or would I rather have those stocks? I think all of those things are actually behaving relatively rationally right now, given the set of facts that the market's chosen to believe. I don't think there's tons of credibility on certain data points, whether it's jobs, whether it's housing's impact on inflation, et cetera. But if you're taking the data at face value, I think the market's behaving rationally, specifically in the fixed income world.
Yeah, you could write the same article and say, what is AMD's price action saying about what Kevin Warsh is going to do?
Right.
Well, you could argue that they think he's going to cut because cutting would be great for chip stocks. It's like, but no one writes that article because it sounds insane, because But like, what is the price of Apple saying about Kevin Warsh? I don't know. There are 8 billion participants who all say Apple should be $315 a share or whatever it is right now.
Yeah.
And that's what the price is.
That's the price.
And that's the same for the 2-year. And we should all just accept that Kevin Warsh is one man, and there are 8 billion people on this planet who direct markets with their actions and moves and thoughts. So
Trump says we're going to get an Iran deal in the next 2 to 3 days. We don't know anything new on that, and I remain. I'll believe it when I see it. I just don't think there's any chance that's true. But
it's always T plus 2 is 3. That's the thing.
Yeah. So don't hold your breath on that one. We'll wrap it up there. We'll be back tomorrow. You guys have a great day.